Okay, now let's proceed to see how we prepare a statement of cash flows. So we need information to prepare the statement of cash flows, right? So the information usually comes from three sources. So first, the comparative balance sheets. Second, the current income statement. And third, some additional information. So very shortly, you will understand how we make use of these three sources to prepare a statement of cash flows. So remember that there are three sections in the statement of cash flows: operating, investing, and financing. So let's get started with the first section, operating. So cash flows from operating activities can be reported in two ways, either the direct method or the indirect method. So these two different methods only apply to the first section, the operating activities section. Okay, so we usually use direct method only in the investing and financing activities section. Okay, so we will discuss these two sessions later on. So now let me tell you more about the direct method in the operating activities section. So the direct method separately lists each major item of operating cash receipts, for example, the cash received from customers, and also each major item of operating cash payments, such as the cash paid for merchandise inventory. So the cash payments will be subtracted from the cash receipts, okay, to determine the net cash flows from the operating activities. But as mentioned in the previous sessions, sometimes this direct listing may not be preferable because the amount of cash transactions could be large, or the information about the cash transactions may not be sufficient. So that's why we introduce another method, okay, for preparing this section. Okay, and this method is called the indirect method. And in this indirect method, we analyze the non-cash balance sheet accounts in order to determine the cash flows from operating activities. So the indirect method works like this. Okay, so first of all, we report the income figure, okay, at the top, and then we make some adjustments to this income figure in order to arrive the net cash flows from the operating activities. So later on, you will learn how to make these necessary adjustments to reconcile the income to the net cash flows from operating activities. Okay? But remember, no matter we are using direct or indirect method, you should arrive the same figure of the net cash flows from operating activities. But since the indirect method is easier to apply, so many companies in the business industry use the indirect method in preparing their statement of cash flows. Okay, now let's move on to see how we use the indirect method to work out the net cash flows from operating activities. So the indirect method starts with the accrual-based income on the income statement, and then we make some adjustments to arrive at the net cash flows from operating activities. So there are three kinds of adjustments. First, we add back any non-cash expense items such as depreciation and amortization. The second, we adjust for any gains and losses related to investing or financing activities, but not related to operating activities. And then third, we adjust for any changes in non-cash current assets and current liabilities. So I'm going to explain these three adjustments one by one. Okay? So let me first explain why we need to make adjustments of non-cash expense items, such as depreciation and amortization. Okay? So you can take a look on this simple example. So here we have cash sales, $100. Okay, so you receive cash, okay, from these sales, $100. Okay, and then you have cash expenses, $60. Okay, so you pay cash for these expenses, okay, amounting to $60. And then we have depreciation expense, $15 in the current accounting period. So that's why you have income before tax, $25 on the income statement. So given this information, what is the company's cash flows from operating activities? $25? The answer is no. So although we have $25 income before tax, it doesn't mean that you have $25 cash flows from your operation. So this is because the income figure on the income statement is an accrual-based income, but not cash-based income. So as you can see from this example, we have $15 depreciation expense, which is a non-cash expense item accrued in the current accounting period, meaning that it is an expense in the current period, but actually it does not have any cash outlays. Okay. So what is the company's cash flows from operating activities? $40, right? So actually you are using the income $25 and then you add back the $15 depreciation expense to arrive at the $40 cash flows from operating activities. So the same logic can be applied to other non-cash expense items such as amortization of intangible assets. Okay. So now let me explain the second type of adjustments. Okay, so why do we need to make adjustments for the gains and losses related to investing and financing activities? So the reason is very intuitive. Okay, we are preparing the operating activities section, right? So any transactions that are related to investing or financing activities should not be included here. So that's why we have to kick them out. Okay? So maybe you can take a look on this example. So here we have cash sales $100, cash expense $60. We also get a loss on selling the marketable securities for $10. And then we have a gain on selling the PPE, $20. So that's why we have income before tax, $50 on the income statement. Okay. So given this information, what is the company's cash flows from operating activities? The $50 income before tax? Of course, no, right? So the sale of marketable securities is actually a kind of investing activities. It should not be included here because we are preparing the operating activities section. So this loss should be kicked out. So that's why we have to add this loss back to the income. Okay. Similarly, the sale of the PPE is also a kind of investing activities. So again, it should not be included in this first section. So that's why this $20 gain have to be kicked out from this section. So you have to minus this $20 gain from the income figure. So after these adjustments, the company cash flows from operating activities can be found indirectly as $40. Okay? So remember, we cancel out the investing or financing gains by subtracting them from the income figure. And we cancel out the investing or financing losses by adding them back to the net income figure. Okay, now I'm going to explain the final type of adjustment. We adjust the changes in non-cash current assets and current liabilities. So the chart showing here illustrates how we treat a change in a non-cash current asset or current liability in the operating activities section of the statement of cash flows. Maybe a couple of examples will help you see how this table works. So let's start with current assets. So suppose accounts receivable, which is a current asset, increased during the year. So this increase would be subtracted from the income figure. So let's see why this happens. So we have a simple example here. Okay? So we have credit sales, $100, and then we have cash expenses, $60. So that's why we have income before tax, $40 on the income statement. So from this information, what is the company's cash flows from operating activities? $40? Not so sure, right? It is because we do not know how much cash we actually receive from the credit sales that we make in the current accounting period. So let's assume these figures. So from the balance sheet, we find that the beginning accounts receivable, okay, the accounts receivable at the very beginning is $10. But then at the end, the ending accounts receivable is $15. So what does it mean? It means that during this current accounting period, the customers owe us $5 more, okay, from the credit sales. So in other words, we have not received $100 cash from the credit sales. Instead, we have only received $95 cash from the credit sales. So as a result, the company's cash flows from the operating activities is only $35. So now can you see the logic in this table? So since accounts receivable increased from $10 to $15, the increase of $5 is subtracted from the income figure, and therefore the cash flows from operating activities is 40 minus 5, okay, $35 net cash flows from the operating activities. So the same logic applies to when there is a decrease of current assets, such as accounts receivables, inventory, prepaid expenses, etc. So any decrease in the current assets would be added back to the income figure in order to arrive the net cash flows from the operating activities. And the reverse is true for current liabilities. So you can take a look on this simple example to understand the rationale behind. So here we have cash sales, $100. Cash expenses, excluding salaries, $50. Salaries expense in the current accounting period is $40. So that's why we have income before tax, $10 on the income statement. So from this information, what is the company's cash flows from operating activities? $10? Not sure, right? Because we do not know how much cash we actually paid to our employees for the salaries in the current accounting period. So let's assume these figures. So at the very beginning, we have salaries payable $40, and at the end, we have salaries payable $45. So what does it mean? It means that overall, during the current accounting period, we owe the employees $5 more of their salaries. So in other words, we have only paid $35 cash to the employees for the salaries in the current accounting period. And as a result, the company's cash flows from operating activities is not $10. It should be $15. Now, can you see the logic here? Since salaries payable increased from 40 to 45, the increase of $5 is added back to the income figure in order to arrive the net cash flows from operating activities, $15. The same logic applies when there is a decrease of current liabilities such as accounts payable, salaries payable, etc. And any decrease in current liabilities will be subtracted from the income figure to arrive at the net cash flows from operating activities. Okay, so let's do a summary here. So we are using indirect method to prepare the operating activity section in the statement of cash flows. So we start from the income figure, and then we make 3 types of adjustments to arrive the net cash flows from operating activities in the end. So the first type of adjustment is to add back any non-cash expense items such as depreciation and amortization to the income figure. The second type of adjustments is to adjust any gains or losses that are related to investing and financing activities. So we add back the losses, but we subtract the gains from the income figure. And the third type of adjustment is to adjust for the changes in non-cash current assets and current liabilities. So we make use of this table. So if there are any increases in current assets, we subtract the increase from the income figure. If there are any decreases in current assets, we add back these decreases to the income figure. And we do the reverse for current liabilities. If there are any increases in current liabilities, we add these increases to the income figure. If there are any decreases in current liabilities, we subtract these decreases from the income figure. Okay? So hope you understand the rationale behind. Okay? Don't just memorize these rules, okay, in the tables. Okay? Please try to understand the rationale behind. Okay? So let's move on to look at a practical example, okay, to apply these concepts. So we are going to prepare the 2011 Statement of Cash Flows for Genesis Incorporation using the indirect method. This slide shows the December 31st, 2010 and 2011 balance sheets of Genesis, along with its 2011 income statement. We use these financial statements to prepare a statement of cash flows that explains the 5,000 increase in cash for 2011 as reflected in its balance sheets. This 5,000 is computed as cash of 17,000 at the end of 2011 minus the cash of 12,000 at the end of 2010. In addition to the financial statements, Genesis discloses these additional information on its 2011 transactions. So let's focus on items A, C, and E for the purpose of preparing the operating activities section. We will use the other information for preparing the investing and financing activities sessions later on. For item A, the accounts payable balances result from merchandise inventory purchases. That means we incur accounts payable only for buying inventory from the suppliers. For item C, we sold property, plant, and equipment with an original cost of 30,000 and accumulated depreciation of 12,000 for 12,000 cash, yielding a 6,000 loss. For item E, we paid 18,000 cash to retire notes with a 34,000 carrying amount, yielding a 16,000 gain. Retire means we settle the notes by paying back the note holders. Sometimes the notes are traded in the open market with prices up and down, so the company may incur gains or losses when retiring the notes. You will learn how to account for these notes in higher level of accounting courses. For the purpose of preparing a statement of cash flows here, we only need the information about the note carrying amount and the cash payment for retiring the notes. With the comparative balance sheets, the current year income statement, and these additional information, so let's see how we prepare the operating activities section using indirect method. So remember, when using the indirect method of reporting, we start the statement of cash flows with income before tax, and then we make some adjustments to reconcile the income to the net cash flows from the operating activities. So for Genesis, income before tax is 53,000, as illustrated on the previous income statement provided. From the comparative balance sheets as shown here, we can first determine the change in the non-cash current assets and the current liabilities. So first, accounts receivable increased 20,000 from a beginning balance of 40,000 to an ending balance of 60,000. This 20,000 increase in accounts receivable is subtracted from income. So here, we write increase in accounts receivable and deduct the 20,000 from the income figure. So second, merchandise inventory increases by 14,000 from a 70,000 beginning balance to an 84,000 ending balance. So this 14,000 increase in inventory is subtracted from income. So here, we write increase in inventory and deduct the 14,000 from the income figure. So third, prepaid expenses increased 2,000 from a 4,000 beginning balance to a 6,000 ending balance. So this 2,000 increase in prepaid expenses is subtracted from income. So here we write increase in prepaid expenses and deduct the 2,000 from the income figure. And finally, accounts payable decreased 5,000 from a beginning balance of 40,000 to an ending balance of 35,000. So this 5,000 decrease in accounts payable is subtracted from income. So here we write decrease in accounts payable and deduct the 5,000 from the income figure. The second adjustment is for operating items not providing or using any cash. The income statement usually includes some expenses that do not reflect cash flows in the period. Examples are depreciation, amortization, and bad debt expense. The indirect method for reporting operating cash flows requires that expenses with no cash outflows are added back to the income figure. So for Genesis here, depreciation expense is the only operating item that has no effect on cash flows in the period. So we must add back the 24,000 depreciation expense to the income figure when computed the net cash flows by operating activities. The third adjustment is for non-operating items. Income often includes losses that are not part of operating activities but are part of either investing or financing activities. Examples are a loss from the sale of a plant asset and a loss from the retirement of notes payable. The indirect method requires that non-operating losses are added back to income. Similarly, when income includes gains which are not part of operating activities, the indirect method requires that non-operating gains are subtracted from income. So Genesis reports a 6,000 loss on sale of property, plant, and equipment as part of the income. So this loss is a proper deduction in computing income, but it is not part of the operating activities. Instead, a sale of property, plant, and equipment is part of investing activities. Therefore, this 6,000 non-operating loss is added back to the income figure as illustrated on this slide here. Adding it back cancels the loss. Later on, we will explain how we report the cash inflow from the asset sale in the investing activities section. Genesis also has a 16,000 gain on the retirement of debt that is properly included in the computation of income, but obviously it is not part of operating activities. So this means that the 16,000 non-operating gain must be subtracted from the income figure to obtain the net cash provided by the operating activities. Subtracting it cancels the recorded gain. So again, we will describe how we report the cash outflow to retire the debt later on in the financing activities session. So here comes to the end of session 3. Now you can try the concept quiz to test your understanding in this session.